Let us now understand the recognition and measurement aspects related to defined benefit plans. Now, let me tell you friends, this is one of the most complex topic and discussion in this particular standard. I used to be really scared when I used to learn about this in accounting standard 15, but once I understood the logic, it no longer scared me. Okay, so what you should also be doing is first understand the underlying logic based on which the accounting treatment is given. Don't worry about so many definitions to learn, so many concepts to understand. That is the wrong way to approach. First understand why we are doing what we are doing, and then how to do all of that will follow automatically. Okay. Now, coming to defined benefit plans, we'll take a very simple example. We'll reduce the number of periods and we'll take only one employee and try to understand what could be the various impacts that we need to consider. Okay. We'll take the example of a gratuity plan.
To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Say at the beginning of year 1, an employee joined an organization. Okay. And the organization has a gratuity plan under which the employee would be paid certain gratuity after completion of 5 years of service. And for simplicity's sake, let us assume that once he completes 5 years of service, on the very next day, the employee resigns, and because he resigns, he will be entitled to gratuity payment. Okay. Now, how is the gratuity payment decided? Say for example, half month salary for every completed year of service. Okay, half month salary. Which salary is this? This is the salary as at the end of year 5 or on the last working day. Okay, whatever is that salary, based on that salary, we will compute half month salary, and for 5 years we will make that payment. Now, assume for a moment when he joined, the salary was 1 lakh. And based on entity's past experience, actuarial assumptions, valuations, all these things put together, it is expected that by the time he resigns, his salary will be 2 lakhs. Okay. Now, how will we compute the gratuity payable, or how will we calculate the amount of gratuity for that employee? Gratuity will be half month salary, so 1 by 2 for 5 years, right? 5 completed years of service multiplied by 5 multiplied by last drawn salary, which is 2 lakhs. So, 2 lakhs multiplied by 5, and if you divide it by half, how much do you get? You get 5 lakhs. So, 5 lakhs is the lump sum gratuity amount which will be paid to the employee at the end of year 5, right? If he resigns at the end of year 5. Now, few things that we need to answer. Is this gratuity which is payable at the end of year 5 an obligation on the entity? Yes, there is an obligation on the entity that if the employee completes 5 years of service, we will have to make a gratuity payment of 5 lakhs. Okay, so there is no escaping. The entity cannot say that I will not pay you gratuity. The entity has to make that payment of gratuity to that employee. Okay. Now, this 5 lakhs, if you look at it from the point of both the entity as well as the employee, when did the employee render service to earn that 5 lakh of gratuity? The employee rendered services for 5 years to earn the gratuity amount at the end of year 5. So, though it is paid at the end of year 5, the benefit that the employer has derived, the service that the employer has received is for the 5-year period and not only at the end of year 5. So, logically speaking, this payment of 5 lakhs should be accounted for as an expense in each of the years, correct? Now, another question that comes to our mind is, the payment is 5 lakhs. Can I do something like 1 lakh, 1 lakh, 1 lakh each year and charge it off to the P&L as a salary expense? Can I do that? Think of it. See, we are settling the amount at the end of year 5. Now, at the end of year 5, we are paying 5 lakhs, and say for a moment, out of that 5 lakhs, 1 lakh pertains to year 1. Okay, 1 lakh pertains to year 1. We are paying 1 lakh at the end of year 5. So, if you have to account for it as an expense at the end of year 1, we will have to discount that, right? So, we cannot say that every year 1 lakh will be the expense. We will have to consider the time value of money. We will have to use a discount factor to arrive at what will be the expense that will be recognized at the end of each period. Okay, so as far as an expense is concerned, we have to see how do we calculate this expense amount which has to be recognized, which we generally refer to as current service cost. Don't bother about the definition or the terminology, just understand that this is an expense to be booked in a particular year. That is one aspect. Okay. Now, let us say I have calculated the present value of 1 lakh and brought it to the end of year 1, and I have arrived at some number. For argument's sake, let us say it is 60,000. That is the estimate of obligation at the end of the first year. But this 60,000 will not remain 60,000. Every year we will have to add interest on that, so that at the end of year 5 we reach the final amount of 1 lakh. Similarly, for year 2 we'll have to do the exercise, year 3 we'll have to do the exercise, and for year 4 and year 5 we'll have to do the exercise. So there will be an element of interest cost also. So you have an element of service cost, that is the employee benefit expense. Then we'll have an element of interest cost. Then we have this obligation at the end of year 5. At the end of each year also, we need to estimate what is the obligation on the employer for the services which the employee has already rendered, right? This is one aspect broadly which covers the recognition of expense and the liabilities. Now, another aspect that we need to understand is the employer knows that at the end of year 5, I have to pay 5 lakhs to this particular employee. One option is I do not make any investments, I do not keep aside any amount, right? Obviously, I recognize the liability, but I do not make any investments. Whenever the employee resigns, I just pull out 5 lakhs from my bank account and pay to the employee. But this is a very risky proposition because on that day you may not have 5 lakh rupees of balance in the bank. Now I am talking about one employee, there could be thousands of such employees. So what employers generally do is they know that they have to make a payment of a benefit at the end of 5 years. So to meet that particular expense, they start investing some amounts in some assets. Like we also do in our families, right? If there is a marriage coming up, or if at all there are amounts to be kept aside for education or purchase of a car or a home, we keep aside some amount separately, right? Similarly, what the employer can do is, employer can keep aside some amount every period, right? And invest that amount into some assets. Why is he investing those amounts? He is investing those amounts so that whatever is the amount invested plus the return on those investments, whatever is received, that can be used to make the payment of gratuity. Now the question may come, what if there is a shortfall? If at all there is a shortfall, he'll have to add more money to that and make the payment to the employees. Now these assets which the employer creates is called plan assets, and the return which these plan assets generate is called return on plan assets. So if you broadly look at this discussion what we had so far, there is a cost or an expense to be provided, there is an interest expense on that particular cost. Then there is an obligation which is a liability. Apart from that, there are assets as well which the employer would be creating, and there is income on those assets which the employer would be earning, right? We will have to understand different dimensions of all of these components that we have discussed just now. What we will do is, we will take an example of again the same gratuity, we will assume some discount rates and see how do we calculate these expenses, how do we calculate the interest, how do we calculate the obligation, and then we will look at the definition and understand more aspects onto that. Let's now have a look at a question and understand how do we calculate these related expenses and liability. We'll come to the technical terms later, okay? So don't be bothered about, sir, we have not done the definition, how do we calculate that? Don't worry about all of that. First understand how it works, okay? Then for each component, we'll see what is the definition and what it includes and how do we calculate all of that. So a company has an employee benefit plan which involves a lump sum payment to employee on termination of service that is equal to 1% of final salary for each year of service. So something like gratuity. Okay, there we said 15 days, here we are saying 1% of salary. Consider the salary in year 1 is rupees 10,000 and is assumed to increase at 7% compounded each year. So basically, if you start with 10,000, next year your salary will increase by 7%. Then next year after that, your salary will increase by another 7%. Like that, the salary will keep on increasing 7% on a year-to-year basis. It's so compounded basically means we are not saying 7% per year. 7% of the previous year is what will be the salary increase, right? Then taking a discount rate of 10% per year, you are required to show benefits attributed year on year, the obligation in respect of this benefit. Now, when we say obligation, we are basically talking about the liability, right? Now, what we will do is, we will see how much is payable at the end of year 5 and how do we apportion that payment to each of those years. That is what we need to understand. That is a fundamental thing that you need to understand for defined benefit plan. If you are thorough with this concept, remaining related concept will not be a challenge. Okay. Now, what is the thing? We have to do it for an employee who is expected to leave at the end of year 5. Okay, so basically we are assuming that, as I gave you an example, joining at year 1, leaving at the end of year 5, and we are not assuming any other changes like salary increased by a higher number or the discount rate changed. All of those things we are not considering. We are just assuming that the employee will join at year 1, he will retire or he will resign at the end of year 5, and because he has completed 5 years of service, we will have to pay him some lump sum payment. Okay, what if he resigns earlier, what if he continues later? We are not computing all of those things for now, right? A simplistic assumption related working. So first we need to calculate what will be the salary at the end of year 5, right? Only then we'll get to know how much is payable at the end of year 5. So salary at year 1. What is the salary at year 1 given? 10,000. Okay. This is what is the salary at year 1. Now, what is the annual increment? Annual increment is 7%. So, what will be the salary at year 5? Salary at year 5 will be basically 10,000 of salary in year 1 growing by 7% each year. Now, for how many periods will the salary grow? See, we are at year 1. Year 1 salary is 10,000. So, in year 2 it will increase by 7%, year 3, year 4, year 5. So, we have to see how much will be the salary in year 5, basically considering 4 periods of growth. Okay, it is not 5 periods of growth, it is 4 periods of growth. From 10,000 of year 1, you will have to see year 2, year 3, year 4 and year 5, basically have 4 periods of compounding. So, what will be the salary? Salary will be 10,000 multiplied by 1 plus 7% to the power of 4. Why 4? Because we have to see increment over a 4 term. Why 4 and why not 5? Because we are seeing increment from year 1 to year 2, year 2 to year 3, year 3 to year 4 and year 4 to year 5. So, there are only 4 terms. Okay. So, how much will that be? That will become 13,108. This is nothing but your future value formula. Future value is equal to, or amount is equal to, present value multiplied by 1 plus r to the power of n, right. Now, I do not expect at a CA final level that you calculate it on a yearly basis, 10,000 for year 1, then 10,700 for year 2, then on 10,700 add 7%, don't do that. You can directly use this formula and arrive at the amount. Now, what is the benefit payable? That is what is important. Benefit payable is equal to 1% of final salary for each year of service. So, here what does this 1% of final salary mean? Means 1% of the final salary that you have arrived at. Okay, so here this 10,000 is salary for the entire year, and similarly 13,108 what we got here, this 13,108 is also for the full year. It is for the full year, it is not on a monthly basis kind of a thing. 1% of this for every year is payable. So, 1% of this is multiplied by 1%, you get 131. Okay, so we'll round it off to 131, and total benefit payable is how much? 131 multiplied by 5, which you get 655. So, at the end of year 5, the employee is entitled to 655. This is the payment that has to be made. Now, this 655 of payment pertains to how many years? It pertains to 5 years of service. It pertains to 5 years of service. So, we will have to recognize expense in each of the year. We can't say that because we are paying at the end of year 5, we will recognize it as an expense only at the end of year 5. That is incorrect. We will have to split this and calculate the amount which is attributable to each year of service. So, what we will do is this 655 we will divide it into 5 periods and then see how much is the expense which is attributable to each year. So, year 1, years. So, we will have years, benefit, how much of the benefit is attributable. Now, this benefit is based on the future value. So, we will have to see how much is the present value of that. Okay. So, we will have a present value calculation also. So, you will have your benefit, you have cumulative benefit, benefit for the year, cumulative benefit, then present value factor, present value, right. These are the things that we need to understand. So, you have 5 years, 1, 2, 3, 4, 5. Okay. You have a total of 5 years. For each year, how much is the benefit attributable? For each year, benefit attributable is 131, or you can do 655 by 5 also. Okay. 131 there, 131 here, 131 here, 131 here. Okay. That is the benefit attributable individually for each of those years. Okay. What is the cumulative benefit? Cumulative benefit, this is undiscounted. This benefit that whatever we are writing is undiscounted. Okay. Now, if you see cumulative, it is 131 at the end of year 1, 131 plus 131, 262, then 393, 524, 655. That is how you get the cumulative value. These are undiscounted. These two are undiscounted, and let me tell you, these two are not relevant for us to pass any journal entries or do any kind of accounting. Okay. What we need to do is, we need to arrive at what is the present value of this, what is the present value of this, and accordingly we will have to do the calculation. Now friends, please understand, when I say that there is a benefit of 131 attributable to year 1, what does that mean? Out of this 655, 131 pertains to year 1. So, this 131 whatever we are saying, this is actually at the end of year 5. It is not at the end of year 1. This is the benefit which is payable at the end of year 5. We have to see what is the present value of this benefit. What is the present value of this benefit? Similarly, this 131 here also is payable at the end of year 5. We have to see what is the present value of this benefit at the end of year 2. Like this we have to calculate for each of the period, right. Now what is the discount factor given in the question? They said take discount of 10% per year. Very good. So we will do the calculation at 10%. Now how do we arrive at the present value factor? Just don't do 1 divided by 1.1 to the power of 5, because we need to see for what period are we calculating. Where are we? We are at the end of year 1. This is at the end of year 1. This is at the end of year 5. Okay, because accounting and all you will do at the end of the period. Now, from end of year 1 to end of year 5, how many periods are there? There are basically 4 periods. So, you have to discount this 131 by 4 periods to arrive at the present value factor and present value, right. So, basically 1 divided by 1.1 to the power of 4 is what you need to do to arrive at the present value of 131, which is payable at the end of year 5 to arrive at its present value. So, the present value factor comes to 0.68. Let me increase the decimals. 0.6830. What does this 0.6830 represent? 1 rupee which is payable at the end of year 5 is equal to 0.6830 at the end of year 1. So, this 131 which will be actually paid at the end of year 5 is worth how much today? Is worth 131 multiplied by 0.6830, which is 89.47. So, the present value of the obligation at the end of year 5 which belongs to or which pertains to year 1 is 89.47. In other words, in this 655 there are two components, one the cost component and interest component, right. For year 1, 89.47 represents the cost component. Similarly, for second period, how much will that be? That will be for a 3 term, or you can do a multiplication by 1.1, that is also fine. 98.42 represents the cost of year 2. Then for the next period you will do a 2 factor. 108.26 represents the cost of year 3. Then you will do a 1 factor. 119.09 represents the cost of year 4, and here because we are at the end of year 5, the factor becomes 1 and entire 131 becomes the cost of year 5. Let me repeat once again. This 655 has 5 components or 5 years. Okay, each year represents 131. Now here something which is paid at the end of year 5, for calculating the value at the end of year 5, what will be the discount factor? It will be 1. So 131 represents the cost of year 5. But if you have to go back by 1 year, if you have to see what is the cost pertaining to year 4, you cannot say 131, because 131 is payable at the end of year 5. If I have to see that value at the end of year 4, I will have to use a discounting factor which is 0.9091 and the value becomes 119.09. Like this I will have to repeat for each year to arrive at the present values. Now, sometimes if counting becomes difficult for you in the examination, what you can simply do is start from the end. Start from the end. What is the end value? Because you are paying at the end of year 5, something which pertains to year 5 will have a discount factor of 1. So, take 1. Then what do I do? 1 divided by 1.9091. Then like we did in the case of lease accounting, right? This divided by 1.1. 0.8264, 0.7543, 0.6830. So, reverse working can also be done if you get confused with the number of years. So, you should not be making mistakes in these simple computational aspects. What did we understand here? I am repeating once again. 655 is payable at the end of year 5. This is in future value. Okay. This 655 of future value is basically representing 131 for each of these years. These are all in future values. Now, how do we do the accounting? We will do the accounting based on present values. What is the present value? All of these represent the present value, and accordingly we will do the accounting for. Okay. Now, a simple thing, just don't do this in the examination. If I sum all of this present value, it comes to only 546. Okay. Now, I am not saying that 546 will be recognized in each year. At the beginning of the year, this represents the service cost. But we are paying 655. What is the difference? The difference is on account of interest factor. Okay. That is what we will do. So, in year 1 you will say my service cost is 89.47. In year 2 you will say 98.42 is my service cost. Then 108.26 is the service cost, 119.09 is the service cost, and 131 is the service cost. Each year you will provide for service cost based on these amounts, right. Now, let us prepare another table and see how do we take this service cost, how does the interest impact this, and how do we ultimately reach the closing balance of 655. Let us now see how do we calculate the interest cost and the obligations at the end of each period. Please understand friends, the service cost that is being recognized is at the end of each period. Okay, so accordingly you will need to calculate interest and also arrive at what is the obligation. Now this all years represent end of the period. Now what is the opening balance of obligation? Now when I say opening here and closing here, this refers to this obligation, right? What is the opening obligation? There is no opening obligation, so it is 0. And when do we recognize the service cost? We will recognize the service cost at the end of the period. So that is how much? 89.47. So service cost recognized at the end of the period is 89.47. Now tell me one thing, if you are recognizing some liability or obligation at the end of the period, do you think you need to provide any interest on that? We will not provide any interest, right? So interest for this period is 0 and the closing balance is your opening plus interest plus your service cost. The closing balance is 89.47. We have done enough of these kind of liability and interest calculations in leases, in AS 16. By now you would have been expert in doing this, right? Then in the second period, what will be the opening balance? 89.47. On this opening balance, that is from the beginning of year 2 till the end of year 2, you will need to provide for 10% interest. So 89.47 multiplied by 10%, interest comes to 8.95 rounded off. Okay, and how much is the service cost? Service cost for second year we calculated to be 98.42. Okay, what is the closing balance? Opening 89.47 plus interest plus service cost 196.84. Similarly, opening for next year, interest 19.68, service cost, closing balance. How did we get 108.26? This number. Then year 4, opening balance 324, interest on that 32.48, 119.09 is that year service cost, closing is 476.36, and at the end 476.36, interest 47.64, service cost 131. Now please note, at the end of year 5, whatever the service cost is being recognized, that is equal to 1% of salary, and because we will be settling it at the end of the same year, there will be no interest cost involved in that. And what is the closing balance? 655. What do we do with this 655? Pay the employee. Now here we are assuming that there will be no changes in any kind of actuarial assumptions, there will not be changes in the interest rate and all of those things. 655 is what will be paid to the employee at the end of year 5. Now each year we have recognized this cost, right? This is called current service cost. This is called current service cost. Why are we recognizing this cost? Because the employee has rendered 1 year of service, and because of which the employee is entitled to a payment at the end of year 5. That is why we are recognizing this cost, and this is called current service cost. Now what is the meaning of current service cost? Current service cost basically represents the cost that is attributable to the service rendered in the current period. So for year 1 it is 89.47, then 98.42, for year 2 108, 119, and for the 5th year it is 131. Okay, that is what is called current service cost. Then what is this interest cost? This interest cost represents the increase in obligation, because we have moved forward by one period. See, we moved forward from end of year 1 to end of year 2. 8.95 represents the interest cost or the interest element, because we are moving 1 year closer to the obligation settlement date, right? This is what is called the interest cost. And what is this 89.47, 196, 324, 476, 655? This is nothing but the present value of obligation. This is nothing but the present value of obligation or the benefit which is payable as at the end of the period for services already rendered. What do I mean by that? 89.47 represents the obligation at the end of year 1 for services rendered in year 1. 196.84, what does this represent? This represents the obligation at the end of year 2 for services rendered in year 1 and year 2. So basically, at the end of the period, whatever is the present value of the obligation, that is, so basically at the end of the period, for example at the end of year 2, what is the present value of obligation? What is the present value of obligation for services already rendered by the employee? That is, year 1 and year 2, whatever is the service, for that what is the present value of obligation? So what are we trying to do here is, if you just want to reconcile this 196.84, For year 1 and year 2, obligation will be 131 multiplied by 2, which is 262. Okay, this 262 is payable at the end of year 5. What is the present value at the end of year 2? So basically we have to discount this by 3 periods, right? This will be paid at the end of year 5. We need to know what is the present value at end of year 2. So basically we are looking at 3 discounting periods. So 262 divided by 1.10 to the power of 3 gives me 197. So if I increase it, it becomes 196.84. So this 196.84 represents the present value of obligation for services which the employee has already rendered in the past, right? This is called a defined benefit obligation. What is it called? Defined benefit obligation, DBO, defined benefit obligation. So in the example that we just saw, we understood what is a current service cost. We also understood what is the interest cost, and we also understood how do we calculate the present value of a benefit obligation. Now when I say a benefit obligation, we are talking about a defined benefit obligation, right? Now what is this current service cost? Current service cost is the increase in the present value of the defined benefit obligation resulting from employee service in the current period. Now if you go back to the calculation that we just did, the closing balance of the obligation was increasing, correct? In every period, the closing balance of the obligation was increasing. One increase was because of the current service cost, that is, the employee has rendered some service in the current period. Because of that, there was an increase in the obligations. So basically, that increase by 89, the increase by 98, right? Those are increase in the present value of obligation because of employee service. Now, apart from this, what was the other factor resulting in the increase? The increase was because of passage of time and because of interest cost, right? So, the increase because of passage of time is called the interest cost. The increase because the employee has rendered the service in the current period, something which pertains to the current period, is called the current service cost. So, you have current service cost and interest cost. Then what is this present value of defined benefit obligation? Present value of a defined benefit obligation is the present value of expected future payments required to settle the obligation resulting from the employee service in the current and prior period. So when we calculate the present value of a defined benefit obligation, we are considering the obligations only for the period for which the employee has already rendered the service, that is in the current period as well as in the previous period, right? That's why I calculated one number and showed you for year 1 and year 2 what is the present value of the obligation. That is called present value of defined benefit obligation. In simple word, this is the closing balance of obligation that you actually calculate.